The market will open tomorrow whether you are ready or not. It opened yesterday and the day before, and it will go on opening long after any of us have stopped caring. That is perhaps the most dangerous thing about it. The sheer continuity of it, the relentless availability of it, creates in most people a pressure that has nothing to do with opportunity and everything to do with psychology. The market is open, therefore something must be done. The ticker moves, therefore a decision is required. That feeling is almost universal among traders, and it is almost universally ruinous. Let us be plain about this from the start. The market does not owe you a trade today. It does not owe you one this week. There is no agreement between you and the tape that says because you showed up, because you paid attention, because you did your work and sat at your desk, a sound opportunity must present itself and reward your effort. Markets are not employment. They are not structured around your need for activity. They move on their own terms, in their own time, for reasons that aggregate across millions of participants and are answerable to none of them individually. The moment you begin to believe the market owes you something for your presence, you have already begun to lose. Now, a thoughtful person might push back here. They might say, surely a trader must trade. Surely a man who sits on his hands indefinitely is no trader at all, but merely a spectator with a brokerage account. And that is a fair challenge. There's a version of patience that is just cowardice, a refusal to act dressed up in the language of discipline. The question is how you tell the difference between genuine selectivity and the paralysis of a man who is simply afraid. And the answer is this: the man who is afraid is waiting for certainty, which will never come. The selective trader is not waiting for certainty. He is waiting for a specific kind of condition, a situation where the weight of evidence, the structure of the market, the behavior of price, all point in the same direction, with enough clarity that the risk is defined and the potential is meaningful. He is not waiting to be sure. He's waiting to be right about the odds. Most traders never learn that distinction. They experience the discomfort of inaction, they confuse it with fear, and they cure the discomfort by doing something, anything, to restore the feeling of participation. They buy a little of this, probe a little of that, take small flyers on rumors or hunches, or the simple fact that the market seems to be moving and they want to be part of it. And every one of those trades carries a cost. The commission is the smallest part of it. The real cost is the capital tied up in a mediocre position that is going nowhere, the attention diverted from the genuine opportunity forming somewhere else, and the slow erosion of judgment that comes from making decisions without adequate reason. Each bad trade makes the next bad trade a little easier to justify. This is what the crowd cannot escape. The crowd is made up of people who answer to someone, a boss, a client, a quarterly benchmark, a spouse asking why the account is down. Or they answer to their own psychology, to a self-image that requires constant action to feel legitimate. Either way, they must move, they must generate activity because the absence of activity feels like failure. And so they trade every session and they pay for the privilege in commissions and in the slow accumulation of small losses that never quite heal before the next one arrives. The man who answers to nobody, the independent trader with his own capital and his own judgment, has exactly one advantage the crowd does not. He can wait. He can look at the tape on a given day, find nothing that meets his standard, and walk away. That is not laziness, that is capital preservation in its purest form. Every refusal is a decision. Every session you do not trade when conditions are poor is a session where you did not give ground. You held your position. And in markets, the ability to hold your position, literally and figuratively, is the foundation on which everything else is built. Most people come to the market every day as though showing up is itself a form of work. They sit down, they scan the tickers, they feel the pull of movement, a stock lifting, a price breaking, a rumor running through the tape, and they translate that pull into action, not because the action is warranted, but because sitting still feels like failure, because inaction in almost every other domain of human effort is the enemy of progress. You do not build a business by waiting. You do not learn a trade by watching. But markets are not like other domains, and the man who carries that instinct into them will be quietly bled dry before he understands what happened to him. The crowd must move. That is not a judgment. It is a structural fact. The crowd is made up of people who cannot afford to distinguish between a good trade and an available one, between a clear opportunity and the mere appearance of motion. Some of them are answerable to clients or institutions, required to be deployed, required to show activity as evidence of effort. Some of them are simply wired by temperament and training to equate busyness with productivity. And so they trade. They trade the open because it moves. They trade the close because volume picks up. They trade the middle of the session because boredom is a kind of pressure, and pressure demands relief. Every one of those trades carries a cost, not just in commissions, though those accumulate into something real over time, but in the erosion of judgment that comes from forcing your mind to find reasons where reasons do not exist. Here is the thing about looking for a trade when you need one: you will find it. The human mind is an extraordinary machine for justifying what it already wants to do. If you sit down, resolve to trade today, you will see setups that are not there. You will weight the evidence that confirms your inclination and discount the evidence that counsels patience. You will talk yourself into the marginal situation the same way a man convinces himself the weather is good enough when he wants to go somewhere. And the market, which does not share your need, will take your money with perfect indifference. The independent trader, the man or woman who answers to nobody, who has no client to satisfy, no report to file, no activity quota to meet, has exactly one genuine structural advantage over the professionals, and it is not information, it is not technology, it is not analytical power, it is the ability to refuse. You can close the screen, you can let the day pass without a single entry, you can watch a situation develop for a week or a month, and wait until the odds are so plainly in your favor that the trade almost makes itself. That is a luxury the institutional world does not permit its participants, and it is squandered by most private traders the moment they start treating the market like a place they are required to be productive. Selectivity is a discipline, and like all disciplines, it costs something in the short term. It costs you the trades that almost worked, the moves you saw coming but did not have enough conviction to take, the days when nothing happens and patience feels indistinguishable from timidity. There will be stretches where refusal looks like cowardice. Other traders around you will be making money or appearing to on trades you passed on. That appearance will be painful. It will test the resolution of any honest person. Livermore understood this, and he was direct about it. The money was made not in the trading, but in the waiting, not passive waiting, not hope dressed up as patience, but the disciplined refusal to act until a situation clarified itself fully, until the line of least resistance was unmistakable and the timing had announced itself in the price action itself, not just in your expectation of it. That kind of waiting is active. It is judgmental. It requires you to hold a position in your mind without committing capital to it, and to keep holding it as the market tests your conviction from the outside and your own impatience tests it from within. What most traders never grasp is that every refusal is a form of capital preservation that does not show up on any statement. When you decline a marginal trade, you have saved yourself the loss and, equally important, saved yourself the distraction. Bad trades do not just cost money, they cost attention. They pull your mind into managing a deteriorating position at the precise moment when a genuinely strong situation may be forming elsewhere. The trader who is overextended in a bad trade is not watching the market clearly. He is watching his losses, and the market does not pause to let him recover his composure. There's also this: patience compounds, not in the way interest compounds, mechanically and automatically, but in a subtler and more powerful way. The trader who refuses the poor trades builds over time a cleaner record of experience. His wins and losses are drawn from situations that were worth trading, and so they teach him something. He begins to see more clearly what a genuine opportunity looks like. because he has not muddied his perception with dozens of forced entries that produce nothing but noise. Selectivity, practiced long enough, sharpens the eye. You begin to feel the difference between a situation that is setting up properly and one that merely resembles a setup. That feeling is not mystical. It is pattern recognition built from a disciplined body of experience, and it cannot be purchased or borrowed. It is earned only by the consistent refusal to trade beneath your own standard. The hardest part of all this is that doing nothing is invisible. When you act, you can see what you have done. You can review it, analyze it, learn from it in an obvious way. When you refrain, nothing happens, or so it appears, but the refusal is real. It is a decision with consequences just as concrete as any entry, even if those consequences are felt only as the absence of harm. The trader who sits through a choppy, directionless session without taking a single bad trade has done something. He has protected his capital. He has protected his clarity. He has reserved his powder for the moment when the market finally presents a situation worth the risk. That moment will come. It always does. The question is whether you will be in a position, financially and psychologically, to act on it when it arrives. The man who has spent the quiet weeks trading out of restlessness will greet that moment exhausted and diminished. The man who waited will meet it fresh with resources intact and judgment uncompromised. That is the full practical cost of impatience, and it is never collected all at once. It is taken in small increments, a poor trade at a time, until the account is smaller and the spirit is tireder and the opportunity that finally mattered came and went without being fully seized. There is a pressure that settles over a trader the moment the market opens, and it has nothing to do with opportunity. It is the pressure of presence. You are there, the screen is alive, the numbers are moving, and the simple fact of being present creates in most people an almost irresistible demand to do something, to act, to participate, as though watching without trading is somehow a failure of nerve, a waste of the morning, a confession that you do not belong at the table. But the market does not owe you a trade today. It does not owe you one this week. It is not a wage paid regularly for showing up. It is more like weather. Sometimes it offers exactly the conditions you need, and sometimes it does not. And the farmer who plants in the wrong season because he grew tired of waiting does not get credit for his impatience. He just loses the seed. Most traders never fully accept this. They come to the market with a kind of entitlement that is almost invisible to them, a background assumption that if they watch closely enough, think hard enough, and stay sharp enough, a worthy trade will present itself each day. And because the mind is ingenious in its self-justifications, it will find one. It will construct a case from thin evidence. It will round off the uncertainties and promote the confirming signals and quietly dismiss the doubts. The trade will feel reasoned, it will feel earned, and it will often be wrong, not because the analysis was careless, but because the raw material was not there to begin with. You cannot build a sound structure on a weak foundation, and no amount of technical craft turns a marginal setup into a compelling one. This is where the crowd and the careful trader part ways most sharply. The crowd moves because it must, and it is driven by the need to feel engaged, to recover yesterday's loss, to not miss what looks like the beginning of something. It is driven by the cost of subscriptions and the weight of margin and the social pressure of other people's apparent activity. These are real forces, and they act on real people every single day, and they result in real and unnecessary losses. The crowd pays a tax on its own impatience, and it pays that tax in two forms: commissions on the trades it should never have made, and losses on the positions it should never have entered. You are not obligated to pay that tax. If you answer to no one but your own judgment, if your capital is your own and your time is your own, then selectivity is not a constraint. It is your single greatest advantage. Every institution has a mandate to be deployed. Every fund has a benchmark to chase. Every broker has an interest in your activity. You, if you are independent, have none of those masters. You can wait, you can sit, You can watch a market that is churning and going nowhere and simply decide that it is not offering you anything worth taking and walk away. That refusal is not a loss. It is capital preserved. It is dry powder kept dry. And over time, it is something more than that. It is the slow training of the eye to recognize what a genuine opportunity actually looks like, as distinct from the merely plausible ones that fill most trading days. There is a useful discipline in asking each time you feel the pull toward a trade whether you would still take it if you had not been watching the market all morning, whether you would take it if you had come to the screen cold, with no context, no narrative already built up in your mind. If the answer is no, if the trade depends on the story you told yourself over the past 2 hours to make sense, then you are not trading the market. You are trading your own attention span. And that is a game the market will win every time. Jesse Livermore understood this in a way that most of his contemporaries never did. He spoke of waiting for the pivotal point, the moment when the market itself announces its direction clearly enough that the risk of being wrong shrinks to a size worth bearing. He was not passive in his waiting, he was intensely alert, but he refused to let alertness become a reason to act before the conditions justified it. The distinction matters enormously. Watchfulness is not the same as readiness, and readiness is not the same as obligation. Most people collapse those three things into one. They watch the market, they feel ready, and they translate that feeling into an obligation to trade. The discipline, and it is a genuine discipline, one that runs against every instinct, is to hold those three things apart. To be watchful without being ready when the conditions are not there. To be ready without acting when the setup is almost right but not quite. To act only when watchfulness and readiness and genuine opportunity all arrive at the same moment, because that convergence is the only thing that justifies the risk. Doing nothing is the hardest skill in markets because it feels like failure and looks like laziness, and it pays no psychological dividends in the short run. You cannot point to a trade you did not take and say, "Here is what I made." You cannot feel the small satisfaction of having participated. You simply sit with the discomfort of inaction while the market moves around you, and you trust, on evidence built up over time, that your refusal to chase inferior conditions is a form of discipline that will eventually be rewarded when the right conditions finally arrive. That trust is hard to hold on to. The market will test it repeatedly. There will be days when your patience looks like cowardice because something you passed on ran without you. There will be stretches when every session seems to offer nothing, and you begin to wonder whether your standards have become too high, whether you are protecting yourself into irrelevance. These doubts are natural, and they are also precisely the moments when the undisciplined trader surrenders and takes a trade just to feel alive again. The answer to those doubts is not to lower the bar. It is to understand that the cost of inaction on a bad trade is always lower than the cost of action on one. The bad trade costs you money, confidence, and sometimes position, because a loss taken at the wrong moment can shake you out of your patience precisely when you need it most. The session you sit out costs you nothing except the discomfort of having sat it out. And discomfort, unlike capital, replenishes on its own. Most people who stay in markets long enough eventually learn to wait. What they do not learn, and this is the sharper lesson, is that waiting changes them. The patience you build in one season of discipline does not just preserve your capital, it changes what you are able to see. Here's what happens to a trader who has refused bad setups for weeks, maybe months. He is not bored into dullness. He becomes, if anything, more alert. He has spent that time watching markets move without his money in them, which means he has spent that time watching clearly. There is no position blurring his vision, no open loss making him hope for a reversal, no open profit making him anxious about giving it back. He sees the tape as it is, not as he needs it to be. That is not a small thing. That is the whole game. The man who trades every day is always slightly distorted. He has something at stake in almost every session, which means he is always reading the market with an agenda. He wants the market to confirm what he already owns. He wants it to give him reasons to stay rather than reasons to leave. He tells himself he is analyzing, but he is really defending. He is looking for permission to hold on. The patient trader has none of that. He comes to the tape free of it. He can ask the only honest question, which is what is actually happening here, not what would I need to be happening here in order for me to be right. That distinction sounds subtle, but over a trading lifetime, it is the distance between a man who learns from the market and a man who argues with it. Now, someone will push back on this. They will say that watching markets without trading them is its own distortion, that you need skin in the game to understand how something really moves. That theory and observation from the sidelines produce a kind of false clarity because you have not felt the pressure of real money on the line. There is something in this objection. You cannot entirely know a market by watching it. The weight of a position teaches you things that no amount of paper analysis will, but the objection proves too much. Yes, you learn from being in the market, but you do not learn from being in a bad trade. A bad trade does not teach you the market. It teaches you your own fear and stubbornness, and those are lessons you already knew. The man who forces a trade because the market looked close enough to right and then manages it poorly because he was never fully confident in it has not learned how the market moves. He has learned how he panics. That is a different education and a far more expensive one. The practical consequence of this is something most traders never quite act on. Selectivity and observation are not opposites of participation. They are preparation for it. Every session you spend watching a setup that is not yet right, you are building a mental library of how that kind of move actually develops, what it looks like before it becomes obvious, what the hesitations and false starts look like, how the character of the tape changes when something real is beginning. You are building pattern recognition that does not have the distortion of a position behind it. This is close to what the best traders describe, when they describe it at all. They talk about reading the tape, about the market telling them things, about knowing when the time is right. What they are describing underneath the intuition is accumulated observation, not guessing, watching, waiting, filing away what they see until the picture becomes unmistakable. Jesse Livermore said the big money was not in the individual swings, but in sitting tight through the big move. What he did not say as plainly, but what his method implied at every step, was that you had to have seen enough to recognize the big move when it was just beginning. That recognition was not given to you. You built it in silence by refusing to trade until you were ready to trade correctly. There is a particular suffering that comes from doing nothing in a market that is moving. Every tick feels like an accusation. Every day you stand aside, something is happening without you. And the mind does not handle that quietly. It invents reasons to act. It reframes the chart until a marginal setup looks convincing. It reminds you that you have not traded in a week, that your account is sitting idle, that other people are making money right now. And if you listen to that voice long enough, you will find a trade. You will always find a trade. The market is an infinite source of apparent opportunity, and the mind is an infinite engine for justifying whatever it already wants to do. This is not a character flaw unique to beginners. It sits inside experienced traders too, sometimes more stubbornly, because experience brings confidence, and confidence can quietly become the belief that you ought to be able to read every tape, find something in every session, stay perpetually engaged. That belief is flattering, and it is ruinous. The market does not reward perpetual engagement. It rewards correct engagement, which is a far rarer thing. Most people cannot sit still, not because they are weak, but because the entire structure of their trading life pushes them toward motion. They watch prices all day. They read commentary that frames every move as a decision point. They are surrounded by other traders who are always doing something, always in a position, always discussing their latest entry. Stillness in that environment feels like failure. It feels like you have fallen behind, like you are missing the point, like patience is just a polite word for cowardice. But here is what those people are actually doing when they trade out of restlessness rather than readiness. They are converting their capital into experience they could have had for free, and they are doing it at a loss. Every forced trade that does not work costs them money, yes, but it costs them something more durable than money. It costs them composure, because a bad trade does not end when you close it. It sits with you. It creates a small bias, a slight lean toward recovery, a faint pressure to make back what you lost. And that pressure distorts the next decision, which distorts the one after that. One restless trade, badly placed, can color your judgment for a week. The discipline of doing nothing is not passive. That is the misconception that makes it so hard to practice. Doing nothing in a market that is moving, when your instincts are firing and your mind is generating reasons to act, is one of the most active things a trader can do. It requires a continuous, deliberate choice to hold the standard. Not once, but every hour, every session, every time the tape offers something that almost qualifies. Almost is where discipline lives. Not in the clear cases, those are easy. When nothing is there, even the impatient trader can see it. The test is the almost, the setup that has most of the elements but not quite all of them. The trend that is probably resuming but has not confirmed. The stock that is near a level but has not quite reached it. This is where most traders break. They round up, they give the setup the benefit of the doubt, which is really just giving their own impatience the benefit of the doubt and calling it analysis. Livermore understood this distinction with particular clarity. He spoke of waiting for the market to declare itself, not guessing at what it might do, but waiting until the evidence was unambiguous and then acting. The waiting was not preparation for the trade. The waiting was part of the discipline itself. You were proving through every refused entry that you could be trusted to take only the right ones. That proof is not made once. It is remade every single day you choose the standard over the impulse. And the trader who can make that choice again and again in silence, without applause, without reassurance, that trader has mastered the hardest thing the market will ever ask of him. There is no asphalt boulevard to success in Wall Street or anywhere else. Why additionally block traffic? Play the lone hand. The full board is at charthorizon.com.